Andrew Holland, CEO at Avendus Capital Alternate Strategies, joins us right now on the show. Andrew, good having you for the first time in our studios. Yes. Welcome. What does it look like, Andrew? 2 days ago, it seemed like the world was in a bit of a risk-off mode, but suddenly yesterday, the Bloomberg was flashing that we might reach a trade deal, and the color has changed a bit. It's very volatile.
So I don't think we're going to get a trade deal. I think we're going to get a tariff deal.
Okay.
And that's, I think before the 15th of December is when the next set of tariffs would kick in. So I think it's going to be a tariff deal. A trade deal could not happen, partly because it wouldn't get through Congress. And that's why I think Trump a few days ago said, a trade deal will happen after the elections, and that's exactly what's going to happen. So I don't think. So what you want is a tariff deal and then a roadmap for the trade deal. And I'm sure that Trump is going to say, I'm the only one who can get a trade deal with China ahead of the elections, and so that's going to play into his court. So as long as we have a kind of a roadmap and there's positivity around doing a trade deal, then I think markets will like that, because what you're going to have is no tariffs, or hopefully no tariffs. Global growth will then start to, expectations will pick up, and you're going to have interest rates lower for longer. And that's a great Goldilocks scenario for equities going forward.
Which are already at record highs. Right.
Yes, so I think the market's expecting that kind of Santa Claus extra rally on the back of this trade tariff deal.
Do you think that this move that we've already had, we have record highs, is sustainable? Do you think we'll stay here and move forward from here? That's the.
I think our markets will, along with kind of so if we have the tariff deal, what will happen is that everyone will say global growth will pick up. That's good for emerging market. Emerging market flows will come, and India's weightage will mean that we'll get flows as well. So that will help push our markets. And then in the run-up to the budget, I think we're going to have lots of expectations in terms of how the government can get the demand side going, therefore tax cuts. So I think the markets or the Nifty will probably, between now and then, we'll get to that 12,500 level.
Just to that point that you mentioned about India's weightage, I think in the MSCI World Index, it's closer to about 9%.
Yes, exactly.
The last time we checked, there was not a material dip in terms of the foreign holding with regards to that weightage. They were somewhere around 8.5. So they were pretty much at par to what the weightage stands at. So do you see them going overboard and giving a premium to India then, because they're already at weightage?
No, I don't think we're going to get a premium. I think so as flows come into emerging markets, obviously there's other emerging markets out there which are more export kind of led in terms of their growth, and their PE is a lot cheaper than India. So we will just get flows. I don't think we're going to get a disproportionate amount of flow. We'll just get our weightage.
Okay, you're painting almost a very simple picture about how the entire piece will move one by one into leading up to the budget. The one question that could come in, and there's a chart that is now floating around on the Bloomberg Global Network about the Sensex P, and I know we don't look backward, we should look forward, but just a small look backward suggests that we are at astronomical valuations for the Sensex. The question is, do you think growth will come back in such a way that it will make these valuations look a lot more reasonable?
No, so what's good? What you're talking about, the 10 stocks, I look at Nifty more than Sensex, but basically the PE of the Nifty is what, 18, 19. The broader market below those, it's cheap. It's 10, 11 times. But what's going to get investors buying into that? It's really when the domestic economy starts to pick up fully, right? And we're at least 2 quarters away from that. So I think everyone's going to stick to quality. And I was meeting some of the leading companies over the last few days at the conference. They're still doing well. Okay. It's not as though they're not doing well. So everyone says, okay, economy's bottoming out, but we're not quite sure. So we'll stick to the leaders in the sector because they're continuing to take market share. And once the economy, you can see signs of it picking up, then we'll start to look at kind of mid cap and small cap.
So the last 1.5 months, Andrew, we've seen some bit of a pickup in the non-leading names as well, those top 10 names. Do you think that is just a bit of a reversion to mean, but the larger money will still flow to the ones which have been performing for the calendar year thus far?
Yeah, I think so. So let's again talk about the flows into India. If we get that weightage from emerging market flows, and it's going to go into your top companies, right? Your top market cap companies. So it's still going to be drag up the top 10 stocks. But I don't think there's going to be high conviction on mid and small cap yet until the economy starts to grow, because they're all operationally geared to a domestic-driven economy.
This is actually pretty similar to what you're saying is in 2018, the money that came in, a bulk of it that went to the mid caps and small caps from the FII side, that is completely reversed now. And any incremental money that's coming in is just moving into the larger names, with the mid caps and small caps being left out. But my point being is, when we're talking about these quality names and these mid caps and large caps, the last 10-year CAGR growth rate for them has been somewhere closer to 10% or maybe even sub for some of these names. So then attracting valuations of 60 times and still going, is that justified?
So let's take Unilever, for example, right? So I met with them the other day. Now, obviously, they've got the GSK merger to come through, and that will be the first quarter. Now they're ready. They're ready to, get all the synergies that will start to come up front for them, and then they've got the pharmacy kind of trade they can go into in terms of their products. So this is a great uplift for their top line, and that falls straight down to the bottom line. So you're going to get growth from Unilever over the next 5-10 years, which where habits dips in some years, but we're not going away from the consumption story. So Unilever will actually do very well. So despite the 60 PE, would I buy it? Of course.
Which is, actually something that I read somewhere was in the US with the Amazon and Google's and their growth rates and the kind of multiples that they attract versus the kind of multiples that we attract. I mean, there's a stark difference because the growth rate is higher there, but the multiples that they get are lower than the multiples that we get, with our growth rate being lower than theirs.
Yeah, if you take Nestle and Unilever and you go back to the European experience, similar size of kind of population, compared to the middle class of India, in those kind of 80s, 90s, and you look at the share price of Nestle and Unilever, you'll just see consistently it keeps going up. The P's remain high because that was the consumption story of Europe. This is the same here. It's not going to change here. So I think we'll continue to pay those kind of multiples and be happy in the fact that you're getting strong growth. You're looking at 10% volume growth in a difficult market. Now, if consumption picks up, then you'll get better growth than that, plus the kind of merger benefits that they'll get as well.
And the return ratios that these companies enjoy any which ways. Yeah, Andrew, okay, one perspective from you, because you guys now run arguably the largest AIF dedicated in India. And how do you think that business is doing? The reason why I'm asking this to you is a lot of people are betting on the capital market linked businesses, and aside of the two AMCs listed, there is now also a wealth management firm listed. You guys might be coming out with an IPO very soon, maybe, and hopefully that will work. But a lot of the brokerages as well. So I just want to understand, how do you think the next 5 to 10 years are poised for growth for capital market linked businesses? Which are the ones that you think will give the biggest bang for the buck?
So I think you've got to look across the different parts of that, because it's a $5 trillion economy. If we ever get there, will be, the financial services will play a big part of that. Now, do you want to be in the insurance side? Do you want to be in asset management side? So on the asset management side, obviously you only have a couple of players there. So there's a scarcity value as well. So I'm sure we'll see more and more players come through. But the P's are fairly rich, shall we say. But that's working on the basis that over a long period of time, it's a bit like kind of what I talked about Unilever. You will see more and more people being attracted to financial products. So the growth is not going to go away. You might have dips here and there, as markets will be volatile in periods. So, would I be chasing? A little bit probably because of the scarcity value, but not kind of chasing too hard at the moment.
Do you are you going big, or rather are you optimistic on how the housing segment plays out in India? I mean, so far it's been a bit of a lull. Commercial real estate is doing much better. But do you feel that housing could come back on track now that you've got this special window for stored projects? But that also brings in the other key question of whether the market gets flooded with a lot of inventory.
So there's two schools of thought. One school of thought from yesterday's conference was, builders should take a 25% haircut. I mean, if I was in the UK, what companies would do, they'd take a 25% kind of reduction in their land bank, and then, obviously their balance sheet would take the hit, and then they'd be able to sell inventory because they're bringing down prices, right? And you get cash flow and you move forward. It's a 1 year kind of pain. Now, is the Indian real estate market ready for the 25? Is the banking sector ready for the 25? I don't think so. So I think what I like was Deepak Parekh's kind of view, which is that, you know, we want to lend to some of these companies and borrow for that last mile or last kind of, you know, kind of getting the cash flow there, but don't treat it as an NPA. I think if we could hear from the RBI today something to help banks kind of get this cash flow into the builders to move it forward. But you're still left with that same problem of high-priced apartments which people can't afford. So I think it's not going to help. It will help the cash flows and it'll get things, but it won't really kind of change the situation until everyone takes a more realistic view of where prices should be.
Okay. Anything else, Andrew, that you are up, excuse me, that you feel is a good theme to follow?
I think, you know, the theme in the very short term is going to continue to be large caps, and I don't think you should be looking too further down at the moment until the economy starts to pick up. I think the government's listening and doing some of the right things, so I'm very happy in that respect. And now the global factors are all kind of tailwinds. I think the risks, you know, for global and for India are these. One is Hong Kong's still causing problems, and you know, I dread to think if the Chinese troops ever go in there and do anything, that would send you know, some very bad signals. It looks as though the Conservatives are going to win in the UK at the moment, so that's kind of good for Brexit if that kind of comes through. So that would give a little bit more stability there. I think in the elections for next year with Trump, I think that's a risk in terms of, at the moment it's 50-50, Trump winning not. And we'll have to see how the candidates come through. But there could be, you know, some scares around if he starts to lose any traction, that the next person coming in will have high taxes, and that won't be liked by the market. So that's one risk to watch out for.
Well, all palpable risk, all what we can feel right now, but let's wait and watch. For the near term, you seem to be more bullish, and which is, well, maybe good news from a bull's perspective. The markets are doing well today as well. Andrew, Holland, take a moment to thank you for joining in today. Really appreciate your time.
Thank you.